And it's really important to remember, if we go back to just before the subprime mortgage blew and take it 3 years prior to that, and we listen to the financial media or simply the mainline media, they were looking through rose-colored glasses at the time. They saw nothing coming, no problems coming. The media are largely looking in the rearview mirror to tell us where we're going. And when something finally does hit, they go, well, where'd that puppy come from?
Yeah, I mean, I'm trying to think of the name of the guy that he used the cover of magazines as a financial indicator for the stock market. I mean, if you look at the magazine covers, I'm just thinking of my recent cover of Business Week Bloomberg. You know, you go back to April, John, when the economy was coming out of the first quarter, the numbers were strong. They were strong in the fourth quarter. What did you get? The April 19th cover of Newsweek this year, America's Back, the Remarkable Recovery. That was followed up by the economist, Hope at Last, and it was all about how great the American economy is. Then the Euro crisis erupts on the scene. The front cover of July 10th, the end of the euro. What has the euro done? It's gone from 120 to 130 almost after that. That was followed by the economist. What was it? I think it was the end of May. They had a front cover, can anything perk up the euro? Okay, you get to these same magazines. The Economist at the end of last week, fear returns, how to avoid a double-dip recession. Bloomberg Business Week has a bear on the cover, growling. And then I love my Bloomberg Business Week last week. Amber ways of pain. Do not buy commodity ETFs. Do not buy commodity ETFs. Do not buy commodity ETFs. Well, guess what took off this week? Commodities. And so, just once again, John, it just goes to show you can't look in the rearview mirror. Well, the talk is of saving jobs, but they're actually destroying them. They talk about saving money, and they're spending it. The talk is of cutting the deficit, but they actually are raising it. They talk about cutting taxes, but their actions show that they're raising them. They talk of pay-go, but the act is no pay, but go anyway. They talk of living green, but the act is of living in the red. Maybe the Mayan calendar is right. Maybe everything, as crazy as it sounds, comes to an end in 2012. I mean, just look at the great chasm that has opened up between Washington and Wall Street and the middle class. Are more earthquakes on the way? Well, all the major indexes are now back into negative territory for the year. So here we are, up one week, down the next. That seems to be the market pattern since the beginning of the year. Stocks finished the week in negative territory and are now back in negative territory once again for the year. Up until recently, the battle has been between robust corporate earnings and weakening economic news. Now that corporate earnings season is over, the markets will refocus attention back on the economy. Will we experience an economic slowdown, or are we headed for a double-dip recession?
This is really a difficult time for investors. Stock market is going nowhere, and we have 0% interest rates. A 3-month Treasury bill, less than 0.2%. If you go to the 6-month Treasury bill, less than 0.2%. Up to 1 year, hey, right at 0.2%. And even a 10-year Treasury bill is less than 2.7%. So interest rates way down, stock market going nowhere. People want to invest and make money, but you're also hearing them say, because they're very nervous about everything that's gone flaky, and there's some justification in this, especially given the political pronouncements coming out of Washington, they want no risk. So you're seeing on the tube, it's not a tube anymore, is it? On the flat screen, you're seeing anymore people hawking annuities and bond funds touted as having no risk. Yada, yada, yada. So, Jim, we really need to steer people through. It's not a minefield. It's just a difficult time.
And there is, John, as you mentioned, there are people in the financial industry that are selling, wait a minute, we've got an answer. We've got a free lunch. And the two most popular answers that are being fed to investors are annuities. And annuities are being fed to investors. Look, you don't have to worry. We can get you 6-7%. You won't have the risk and the fluctuation. You can sleep at night. Well, folks, you need to ask yourself a couple questions. The safety of that annuity is only as good as the guarantees and the solvency of that insurance company. Think AIG or go back to the insurance crisis of 91, think Executive Life, which went under. And if somebody's trying to give you 6 or 7%, you need to ask yourself a question. Number one, how am I getting 6 and 7% at a time 10-year treasuries are only 2.7%? How am I getting 7% when junk bonds don't even pay 7%? How am I getting 7% when high-quality corporate bonds are in the 4 to 5% range? And let's not forget the 6 to 8% commission that the broker is getting for selling the product. And let's not forget the 2 to 3% expenses that the insurance company is not providing this product because they're a charitable organization. And a best example I can give of this, John, is, I think this was about a month ago. I had an individual walk into our office with his mother, and they had discovered something, I guess, during the credit crisis. Their estate had lost money, and what they were looking for was safety. And so a financial advisor sold them this annuity contract. And they were, I forget what the number was, they were getting like 6 or 7%. But somebody had told the son that looking at this, that as he began to look at the contract, that there wasn't going to be any assets left to the estate. So they came in, they brought the contract with them, and what they had been sold was a 10-year certain contract on the joint life of the husband and the wife, meaning that in this case, the husband had passed away, so the income payments continued to the surviving spouse. Should she pass away, they were guaranteed payments for 10 years. But let's say the wife was to live 10 years and then pass away, there would be zero, and I mean zero assets left in the estate. What this product was, it had been annuitized, meaning that the principal and interest was coming back. Now, if you don't care what you're going to leave your kids, maybe that's a solution for somebody that needs income. But you need to be made aware of that, that 7% return really wasn't an interest rate return. It was return of principal. And this was never shared with this particular couple when they made that investment. And so you often hear these kind of very attractive pitches that these salesmen make. Or another one is where there's a sucker rate where they pay you like 6 or 7% your first year, and then after that you're hit with penalties. You need to take a look at, if I need to get out of this, what is it going to cost me? And you can find penalties that are as high as 10% or more that last over a decade. So what if interest rates go up from now? What if 3 years from now interest rates start to skyrocket again? You're stuck. And if you get out, you're going to take a tremendous loss getting out of this annuity.
I would take it that you're saying at the same time, in reality, a lot of the security that people are seeking may not be there from now on forward.
Absolutely not. I mean, your guarantee with the insurance company is only as good as the insurance company itself. And because of 0% interest rates, which is the environment we now are in today, insurance companies are taking greater risk. Get a Schedule D and take a look at what that insurance company is investing its money in. And I think you will be surprised that they have lower quality bonds, they have a lot of junk bonds, and they're doing a lot of things in order to get those yields because we are operating in a low interest rate environment. And that's the intention of the Federal Reserve, of keeping interest rates at zero, because they want you to go out and buy bonds. They want you to go out and take some risk. And there's every indication that they plan to keep it that way for several years.
Well, so going back to this Hindenburg omen, which predicts great market crashes with a 77% accuracy rate. So all 5 conditions have been met, and now they need to be reconfirmed to get to the 77% accuracy. The last time it was reconfirmed, according to this article in Zero Hedge, was June 2008. And that's obviously when we spoke to Zapata George. And at the time, Barron's pointed out, quote, there's a 25% probability of a full-blown stock market crash in the next 120 days, caveat emptor. boy, was the emptor caveating. Within 120 days, of course, we had the giant crash. So now this omen needs to be reconfirmed within the next 36 days, which will take us to about October 1st.
Yeah.
And then the crash, which is obviously, for some reason, the classic crash months are October, November. So if this is reconfirmed, the next big stock market crash will happen somewhere between October and December.
Yeah. That would fall into a number of predictable or well-worn patterns of the past.